Good day, Real Vision viewers. This is Tony Greer of TG Macro. This is an exciting day for me today. I get to add a brilliant addition to my roster of interviews. Today, I get to interview my favorite chicken. I'm very serious about that. I want to introduce you all to my good friend Doomberg. Doomberg runs Doomberg at Substack.com, and he is one of the most authentically passionate, talented content creators that I have met since joining this business. And I'm looking to introduce you to him and all of the expertise that comes with him and his background. So without further ado, Mr. Doomberg, how are you doing this morning?
Tony Greer, it's an unbelievable honor to be on Real Vision with you. I'm a huge fan, as you know, a longtime subscriber to TG Macro, and I start every morning with the Morning Navigator. I haven't missed an edition since finding you many years ago. It's really, can't tell you how great it is to be on the show with you.
Oh, this is so exciting, man. Well, we have a mutual respect then, and I can't wait to crack open into, four really right in your wheelhouse topics today. Okay. And now I just want to go over the outline so that people know where we're going here. We're going to talk about U.S. energy policy. We're going to talk about the potential energy crisis in Europe. And we're going to talk about the uranium trade. And then we're going to talk about prepping. But first, I want to go and introduce you to Doomberg his way. I'd love for you, Doomberg, to go ahead and introduce yourself to the Real Vision community and tell us what you're about.
Sure. The Doomberg at Substack.com is sort of a team effort. In real life, we run a bespoke consulting firm. The partners in our firm all come from heavy industry, and combined we have several decades of experience in what people would call the commodities sector. We write about markets. We observe markets. We're not traders, and we don't give investment advice. But we come at the markets from a technology, science, and managerial experience background in the real world. And so we think that's a pretty interesting and unique vantage point to comment on markets. And that's what we do. We try to put out 10 pieces a month. It's been an incredible experiment. We launched Doomberg 7 months ago, and it's been successful beyond our wildest imagination, and in part inspired by people like you and Kevin Muir and some of our friends in the content creation business. We thought it would be fun to jump in the pool, and we created the Doomberg brand and the green chicken, and we've been writing under that name ever since.
Well, with that type of background, I can't begin to tell you what a comfort and a real asset that is to a commodity trader like me. Just from the perspective of speaking to you, speaking to a green chicken with a calm voice and a very soothing demeanor, it sort of takes a lot of emotion out of the trades for me. And I want to go right into one of the trades that has been driving me crazy, that you finally sort of let the air out of that by saying, yeah, U.S. energy policy. I mean, we're shooting ourselves in the foot. It's a very simple way of looking at it. And we started that sort of idea of shooting ourselves in the foot about policy when we cut off the transcontinental pipeline to Canada, and we are, totally clamping down on fossil fuel investment. And I would just love to hear your perspective of how you set up the U.S. energy policy that we've been following here since the Biden administration took over, and what the risks that you see out there in the market are.
Yeah, absolutely. We rewrote a piece called America's Energy Strategy is Bonkers, because as somebody with some experience in the industry, it just makes your head want to explode when you see the self-inflicted wounds that we're doing here. And we come at this from a perspective that there are tangible technology solutions to alleviate humankind's footprint on the environment, and specifically CO2 emissions. We do believe, however, that energy is life, and that we begin our analysis from a human-first perspective. There's a billion people on the planet that don't have access to a sufficient amount of energy to enjoy a reasonable life, and we're talking about restricting energy supply to impact CO2 emissions, and at the same time we're doing things that make that transition incredibly hard. And at the core of our thesis, if I could describe it in 3 words, better is better. So, for example, replacing coal-fired electricity plants with natural gas is better for the environment. It burns cleaner. You produce more electricity for the same amount of CO2 emissions. far less toxic byproducts. America has an abundant excess of natural gas that it can tap into. So, when you oppose blanket fossil fuels, you take away a key tactic that can actually help us get there on the journey. So we call that sort of the path function. The path from today to a better world matters, and how you go about doing it can have serious consequences and unexpected consequences for the world. Another big policy objective for us would be to see a proliferation of nuclear energy. Nuclear energy is very demonized by the very same people who proclaim to care about the planet and abating CO2 emissions, that there is no cleaner, safer, more economic way to produce the electricity that we Americans enjoy and the world enjoys than through nuclear power. And yet, we are setting about the process of not only not building out nuclear energy here, but letting existing nuclear energy facilities go offline. Closing them down is especially true in Germany, which we'll talk about later in the European side of the crisis. But even here in California, where they're having amazing problems with their grid and rolling blackouts, there's a major nuclear energy plant that's set to close. And only now, after all of this sort of spike in energy prices, are local politicians doing a little bit of a step back and saying to themselves, "Hey, maybe that's not such a great idea." But the real motivation for that piece, which we put out several months ago, was watching the Biden administration, as you say, cancel the Keystone Pipeline, which was always a political football. But at the same time, seeing that prices were going up at the pump, begging OPEC to produce more. And if you just take the logical, extension of that strategy to its natural end, we are going to cede the control over our energy policies, and energy is life. So we're going to concede control over our lives to people who don't like us. And that's bonkers. And we're already seeing the Biden administration backtrack on it. And we could have saved them the round trip if they would just stop and think about it and say, hey, maybe we should think about putting more nuclear capacity online, and we should think about using our excess natural gas to replace coal. And we should maybe think about having a friendly supplier of energy from the north, Canada, be, it's not like that pipeline would have been what Biden's doing to Europe. We have great relationships with Canada. We have mutual trade. There's always some disputes. Right. But nobody would say that Canada isn't a reliable energy partner. And yet we slapped them in the face and we turned it off. And so it just doesn't make sense. And we're all for, continuing the development of renewable energy. We're all for massive investment in grid storage. There's some really innovative companies in the space, but coming at it from an industrial perspective, it just makes your head explode sometimes.
Exactly. So what we've done, let's look at the price of gasoline, which is obviously backed off the highs, but dramatically higher since these policies have been implemented. And I want to go to sort of, I like I've listened to every one of the podcasts that you've done, especially with Grant Williams and with George Gammon. And I like the idea that, you call it energy is imposing order on your local environment, right? Energy is civilization. Energy is the ability to, use nature's resources to benefit the living human beings on the planet. And I think we need to continue to go that way. But what I see as gas prices go higher, natural gas prices go higher, we pivot toward the food sector because now ammonia prices are going much higher, fertilizer prices are going higher, which means grain prices are going higher. And I think that we get toward that higher food costs as the point where the rubber meets the road politically. Would you agree with that? That while, the energy costs being 30% of, food and grain costs, we are going to run into a problem with the rising cost of food in this country.
Yeah, and it's at some point, markets get so broken, it's not even about the cost, it's about availability of supply. And we wrote a pretty provocative piece called Starvation Diet, where we predicted much of what we are now seeing unfold in the fertilizer market. When we connected the dots. So one of the advantages of spending decades in industry brings is we can see how various markets are interconnected. And, many companies are not integrated. One company's output is another company's feedstock. And, fertilizer is sort of ammonia plus phosphate. And on the one hand, we're watching natural gas prices double in the US and go up, 3, 4, 5x in Europe. We happen to know that fertilizer production occurs in these areas. The ammonia side of the equation is basically the input is natural gas. And then you need phosphates to make many of the fertilizers, not all of them. But then separately, we noticed that China, responding to its energy crisis echo from Europe, decided to ban the exports of phosphates. And you put two and two together and you realize that, hey, that factory that makes fertilizer now is getting a left jab and then a right hook, and they're just not going to be able to make fertilizer for any reasonable price. They might be locked into supply contracts that fixed prices based on lagging market indicators, and they're just going to declare force majeure and not produce. And then you take the next step down the road and say, if you're an American farmer who paid $200 for your fertilizer last spring and you budgeted $300 and the bill comes in at $12.50, maybe you're not going to buy fertilizer. Maybe you're going to plant less crop. For sure, your margins are going to get squeezed, or food prices have to go up. And one of the things that is extraordinarily frustrating to see is we don't learn anything from history. Food is, energy is life, and food is energy for humans, literally. And the people will revolt. Now, Tony Greer is still going to eat, and the Doomberg team is still going to eat. It's going to cost us more.
Right.
But there are hundreds of millions of people right on the edge for whom price inflation is death.
Right.
And when you have a critical input, so people don't really realize, many do, I'm sure many of your listeners do, that the fossil fuel industry, the energy and gas sector, as you would call it, is also the key input into virtually everything that we see and use in our daily lives. And we wrote a piece called Where Stuff Comes From, just to show people that, if you snap a whip on natural gas in Europe, that's going to snap through very delicate supply chains, and it's going to make a big sound when it hits the floor. And that sound that you're hearing now as the whip hits the floor is fertilizer. It's all manner of packaging. Food packaging has gotten more expensive. You mix in supply chain crises, which are a natural consequence of all of this. There's a story out of China where, manganese exports were being cut off to Europe, and that was imperiling aluminum production, and aluminum production imperils car production. These things are interconnected. Our just-in-time inventory supply chains are really messed up, and huge spikes in inputs like natural gas only make that much worse.
Right. So while we're on that natural gas topic, let's go into a little bit what's going on in Europe, which is just worth following along. As you say, it could be a preview for what we see over here. So what's gone on is Europe has let their natural gas stocks diminish greatly. They're depending on Vladimir Putin and Russia to send gas over through the Nord Stream 2 pipeline. And there are some, regulatory difficulties getting that deal done. So now it leaves them with tremendous Mother Nature risk, right? If they have a colder than normal winter in Europe, they're going to be in for a really difficult time. Now, how do you think that possibly plays out?
So if you think about the genesis of the energy crisis in Europe, it was all very predictable. I was listening to podcasts in the summer where people were pointing out that they were heading into the fall with the least amount of storage they've ever had, that this was going to be a huge crisis. And if Vladimir Putin didn't come through, then they would be in big trouble. How did this crisis begin? It began by an underproduction in natural gas locally, as Europe was mandating the phase out of fossil fuels. This is, again, where phasing out natural gas makes no sense in this environment because we're not yet ready to do it. They replaced the nameplate capacity with intermittent power producing technologies like wind and solar, which is great, except they're very poor baseload power. They're not baseload power, they're intermittent power because the wind doesn't always blow and the sun doesn't always shine. And natural gas and nuclear and coal are baseload powers. And the successful operation of a electricity grid is one of those modern marvels that nobody ever thinks about, but is incredibly difficult to do. And we're finding that out in Europe now. And so in the spring, the price for natural gas was elevated and they held off buying, waiting for prices to come down. Or They assumed that they could make up the difference via pipeline from Russia and LNG imports, liquefied natural gas. We did a whole piece on the LNG market. What happened is the echo of the European energy crisis showed up in China. China has an energy crisis now. And China, President Xi decided that he was going to pay any price for the incremental supply of LNG. There's only so many major LNG exporters in the world, and the three top ones being Australia, Qatar, and the U.S. And China said we're going to hit every ask. So whatever the price is, whatever Europe is bidding, we're going to top it. And if you chart the JKM natural gas for Asia versus the Dutch TTF, you could see Asia's paying slightly more in the incremental supply of LNG, ironically, from the U.S., which is kind of becoming the swing exporter of natural gas. Is the boats are sailing east, and Europe is left to fend for itself. And as you say, roll the dice on the weather. And the weather forecast looks pretty ominous. So they entered this peak heating season with something like 78% of the storage capacity full. Yep. And what we're really seeing is exactly what I referred to earlier. If your energy policy in the U.S. is we're going to restrict supply here, but we're going to beg OPEC to produce more, then you are ceding the power over life of your people to people that don't like you. Well, Europe is now sitting on the edge of a pipeline waiting for Vladimir to come through. Well, as we wrote in another piece, Putin's fools rush in. The geopolitics has never been so easy for the man. I mean, right. So you said, the Nord Stream 2 project is caught up in a bureaucratic malaise. No, Germany still thinking it has cards to play. They're sitting at the poker table with a 7-deuce offsuit. Putin is sitting there with pocket aces, and they go all in. Right. He's going to call your bluff. So, yeah. and you can either hope that it gets warm, or you're going to have serious consequences. And it's not just the easy things that you can see, like people not being able to heat their homes, or the electricity going out and having rolling blackouts. There's an entire manufacturing infrastructure in Western Europe that relies on natural gas as an input. And all of that infrastructure now is at a huge cost disadvantage. Ask BASF in Germany, what's it like to be sitting there with $30 per million BTU natural gas.
And trying to be a chemical producer, right?
Yeah, and then, all the people that need those chemicals.
Yeah.
And the same thing is happening in China. So what has happened as a consequence of Europe's energy crisis is LNG spiked, as we just described, which means China has a energy crisis because it relies on imports of LNG to meet its needs. So you're seeing two things. You're seeing a lot more coal burning, which is counter to global warming, but also things like the price of polysilicon have spiked. So, solar grade polysilicon is, up 4x over last year, which means a lot of solar projects are going to get a little more expensive, a little tougher to do. And so, these things are interconnected. There's an intelligent way to go about this. And there's a cocktail party way to go about it. And the cocktail party way to go about it is big, broad strokes, superficial, unserious policy choices like we're just going to restrict all fossil fuels because all fossil fuels are bad. And
government by platitude, right?
Government by platitude. And ultimately, as you say, the rubber's going to meet the road when food prices in the emerging economies explode.
So the overlay for me with the food issue is sort of coming back out of where we are as a society coming out of the lockdowns, right? There have been so many businesses that have been damaged. There have been so many personal balance sheets that have changed. The vaccination requirement mandate is sort of morphing around the U.S. But what I fear is that, if we have we're having a trucker issue right now, right? We can lose many millions of truckers due to the vaccine mandate that the Biden administration is trying to put down. We can also lose a large number of food processing inspectors, health inspectors that go around to the food processing plants and sort of okay everything. And when I do the overlay of what will happen, when natural gas prices rise higher, food and grain prices are higher, and we have less distribution infrastructure to get food distributed, I see the risk at those food processors in addition to the whole economies built around them. Can you touch on that a little bit, Doom, as far as sort of drilling down a little bit further into economically and financially, like what this could mean? Because I really believe, and I want to get to the sort of end game of this, my sort of argument is that ESG is eventually going to run into, the political pendulum swinging right back in their face. So I kind of want to be prepared for this and make sure that as a trader, we're out ahead of it, prepared for food prices to rise, energy prices to rise. Talk to me about the intersection of that sort of economic storm, if you can.
Yeah, we've written a lot about the just-in-time supply chain crisis, and we do think that major corporations, many have said it before, it's almost a cliche now, but from just-in-time to just-in-case does give an inflationary pulse as businesses rethink how much working capital they need to, safely operate their facilities and avoid a stock out. There is an incredible shortage of labor in the United States today. I should say there is not a shortage of natural gas in the United States. We are well supplied heading into the season. You're seeing, natural gas here with a 430 bid this morning as I'm looking at my Bloomberg, where it's still $30 per million BTU overseas, and that just shows you the issue with supply chains is if when things sell for radically different prices in different places, it tells you there's an arbitrage opportunity and that there's a logistics plug somewhere. And that's what we have going on with natural gas. And then broader in the supply chain, we do a lot of thinking about this and go back and forth. The original lockdown triggered a huge deflationary air pocket in the economy. Then our response to the opening of, the combination of fiscal monetary response and then the reopening of the economy and the speed with which that happened created an inflationary pulse. There's a huge debate, as you know, in the inflation deflation camp. We come from industry and our phone is lit up with executives telling us they can't get supply, they can't get labor, prices have to go up. On the flip side, if we re-enter lockdowns, that's sort of a deflationary countermeasure to that inflationary spike, which I suppose only puts it off until we come out again. And so nobody would say that, the most recent noise around variants are, some kind of master plan to deflate the economy and to abate the inflation spike with Jerome Powell coming out and saying we need to retire the word transitory. But it is an interesting coincidence that this variant showed up at the same time that central bankers really began to worry about the impact of the monetary and fiscal policies that we were seeing when combined with the supply chain snafus that are manifested post-reopening. And so it's a very interesting time. Like you say, oil is off the high, and who knows by the time this publishes what OPEC's going to have done. But there's a lot of moving parts. There's a lot of flow. For sure, supply chain is really messed up. Even still, I know the Biden administration is talking about easing at the ports, but in reality, I think they're just moving ships around, which you can easily watch with a cheap subscription to marine traffic. And so, it's kind of rough up there. Our contacts in industry tell us that the supply chain crisis is not getting better. And then one last thing I do want to say in the North American supply chain crisis, watch what's going on in Vancouver closely. We had the mudslide and the floods. They have this ongoing series of drenching rain. These storms just seem to keep pouring in from the Pacific. Canadian National is having a lot of trouble getting the railroad rebuilt. And people in the U.S. might think that that's not a big deal, but Vancouver is a very important critical infrastructure port. A lot of the world's coking coal, seaborne coking coal comes there, which feeds steel plants. Supply chains are tough. I saw there were more than a dozen coal ships out at sea waiting to be filled. That crisis at the port of Vancouver is being a little bit downplayed in the media right now. We've kept a close eye on it. We've written about it, and that's something to watch too.
Very good. It's really interesting that how you say that the market is sending signals, right? Like there are real signals now to entrepreneurs, in the commodity space regarding these price differences that are happening in the arbitrage opportunities. I want to go a little bit into, back to nuclear and the uranium play, because I loved in the Grant Williams interview that you did, you mentioned that this is a really crisp market signal, right? Like we are going to be needing more electronic vehicles. There's a message to utility companies like, put the shovels in the ground here and start figuring out how to deliver this kind of energy. So let's use that as our pivot into the nuclear discussion, because Tell us about sort of how the signal that the market is sending first and what kind of response we're seeing from the world, including the Sprott Physical Trust, which is the story that I want to kind of wind up at.
Sure. Uranium is a really fascinating market. After the Fukushima disaster, uranium was left for dead. And Germany announced it was going to take off all of its uranium facilities. And Japan obviously put a bunch of things on hold. Uranium mines all around the world closed, and there was excess supply. And, as our mutual friend Cuppy described in one of his great pieces, the utilities have become pretty comfortable with an oversupplied input. Uranium is a pretty small part of the cost of operating a nuclear facility. So you have this amazing case where you can draw the supply curve for uranium miners, the cost curve, for each increment of supply. And at the time, 2-3 months ago, when Cuppy first made this call, and others obviously on uranium Twitter as well, uranium was selling for about $30 a pound, but the marginal cost of production to bring new facilities online was $65 or $70 a pound. And then, as you indicated, we have this really amazing vehicle come online, the Sprott Physical Uranium Trust. Their stated intent is to buy and sequester uranium from the spot market and to tighten up the uranium market. And they've been busily doing so, chewing up supply. The price of uranium sort of jumped at the peak of the excitement from, let's say, $30 to, in the low 50s. It's since backed off to the 40s. It's one of these trades where everybody understands the thesis. The thesis seems very clear, but everybody knows the thesis, and so is there still a trade there? And that's where guys like you come in, because we could look at the fundamentals and get excited about it, but if Sprott keeps chewing up supply and taking supply offline, converge that with nuclear having a renaissance. And then finally, one of the challenges with the Sprott Physical Uranium Trust is it trades in Canada. It only trades OTC here in the U.S. And they're applying for a New York Stock Exchange listing, which of course will get them a lot more, access to potential funds to continue to chew up this supply. But if there's a supply deficit that emerges just as nuclear facilities come back online and new builds get announced, China announced some crazy build-out plan of like 150 nuclear facilities over the next decade. You could get to a point where demand exceeds supply, and in these types of commodities, the inelastic demand, as we're seeing with natural gas in Europe, you could see some crazy prices. The only thing that makes me a little uncomfortable about the trade is everybody understands it.
Yeah, no, for sure. But I like this trade because it is extremely forward-looking. I mean, this is like a Bored Ape trade for the physical commodity markets, if you ask me. This is really forward-looking because, and I'm going to take from your outline that you provided, is that utilities consume around 180 million pounds of uranium a year. Mines make up about 125 million pounds with their production, which leaves a 55 million pound shortfall, roughly, of excess inventory that is sourced from the markets, right? And the inventory, like you said, is not going to be there forever. You've got the option of sourcing it from only 6 countries, really: Kazakhstan, Canada, Australia, Namibia, Niger, and Russia. But what Sprott is doing now is sort of bringing uranium into the mainstream by creating, at least for me and for you, a price point. Right now we've got price discovery, whereas if you would have asked me where uranium is trading, I would have had to get, I don't know, the Wikipedia page, the newspaper. I wouldn't even have known where to look. So talk to me about how we can maybe get to the point where this becomes more mainstream. That's what I'm kind of looking to the code to crack. Like, how do we cut through the nation's fear of nuclear, and will it ever be practical? That I think is the biggest question to this whole trade, because it should become an obvious alternative energy source given the attack on fossil fuels. Tell me your thoughts on that, dude.
Yeah, lots to unpack there. I would start with Sprott and their activity in the market. Your numbers are roughly correct, 180 million pounds and maybe 125 of production. And the cost to get new production online is, like we say, in that 60 to 70 $70 a pound. Sprott, just pulling them up on Twitter as you were talking, they have sequestered an incredible 88 million pounds of uranium just since they started buying. And just to fill people in case they don't know, Sprott is doing an at-the-market offering, and as long as the price of the Sprott Physical Uranium Trust is selling for a premium, they're issuing new shares, which is then used to buy and bid up uranium. And so it's a bit of a delicate dance. If they issue too many shares and then the Sprott Physical Uranium Trust sells for a discount, they can't issue more. But if they bid up uranium, then the Sprott Physical Uranium Trust could sell for a discount. So this is a long-term play. I think the quick, fast, easy money of the early excitement of the Sprott first $1 billion ATM has made its way through the market. Prices have consolidated around the mid to upper 40s. But they're just going to keep churning away, buying and sequestering pounds. And at some point, something has to give, you would think.
The market might very well come to them. I mean, I got a feeling that that's their plan, right?
Yeah. And, to your point, this is the precise objective of Sprott. And, God bless them, that they are trying to make the uranium market more efficient so that speculators can transmit market signals to producers and consumers in the same way that there's far more notional natural gas traded than there is delivered, because people want to be able to express an opinion about where the price of natural gas should be. And to your point, prior to Sprott coming on the scene, there was very few liquid, accessible opportunities for pension funds, hedge funds, money managers to express that view. And to the extent that Sprott is providing that service to the market, more power to them. One of the countermeasures of that, though, is broadly speaking, when commodity markets become more efficient to trade, the long-term trend is the price of those commodities goes down as people are able to hedge, as people are able to prepare for seasonality and pre-buy and things like that. The efficient market hypothesis, basically, which is, as at least as applied in this context, is that in the long run, Sprott will make uranium cheaper than it would have been otherwise. Doesn't mean that it's going to be cheaper than it is today.
I want to just talk a little bit about how we get over the fear, the danger, this is a bit exploratory and not necessarily a direct trade. But to me, if we're going to, Sprott's going to be right, we're going to have to break through the fear of Chernobyl and 3 Mile Island and Fukushima and get rid of all that stigma. Is it even possible? What are your thoughts on that? Like, can we, how would we go about that? What does that process look like?
Yeah. So first of all, that is a great question. And it is very relevant to the trade, because as a trader, if you can see those signals materialize, you say, hey, these are the 4 milestones I'll need to see, and I know it's a go. And then you could get comfortable with the asymmetry of the trade and position sizing and things like that. So I don't think it's an exploratory question at all. I think it's a very relevant one. So you could look for milestones. Illinois recently decided to extend the life of a couple of nuclear power plants as part of a budget process. One to watch would be this nuclear facility in California. If they go through with closing it down, that tells you something. By the way, Germany is facing the same decisions. China is going to be building out. So there's lots of flow here. But to your question, how do we get over the stigma? Ultimately, there's 3 sort of verticals you need to consider as you ponder the relative acceptance of nuclear. 1 is technology, 2 is politics, and 3 is financial. There are no technical challenges to safely expanding the nuclear power fleet. For all of the fear mongering that organizations like Greenpeace bathe themselves in, there is no safer, long-term, grid healthy, baseload power generating technology than nuclear power. And people always reply in our comments, well, what about the waste? Handling nuclear waste is a solved technical problem. It can be done. It's not a challenge. It's political. You don't want to do it in Yucca Mountain. Well, you could do it in Yucca Mountain, but Harry Reid was a senator from Nevada, and he put that project on ice. But don't tell me it's a technical problem. So if you're inventing technical solutions to global warming that require the coupling of 3 or 4 miracles, when you have a solution sitting on the bench like nuclear, don't tell me it's a technical challenge. It's a political challenge. And so you'll see the political tides turning. So in Europe today, there's a move to label nuclear as green. And even in some cases now, natural gas as green, because they're seeing the hard way that when you short the country of natural gas and you got a big giant pile of coal right there, and your choice is, I'm going to heat my house and kick out a few more molecules of CO2, or I'm going to freeze, the choice is easy. And so, the nuclear production, uranium supply, nuclear waste, these are all solved technical problems. The solutions exist. And there's even more innovation, of course, with, pebble-based reactors. And the newest generation of nuclear power that we would build out would be even safer than the ones we have, because the 3 Mile Island accident, which, by the way, didn't injure anybody, that accident really spooked the industry, and they went into overdrive on new safe designs and all this other stuff. And so this is a political will issue. So you have to watch the politics. A key sign for the politics include the California plant and whether Europe labels green nuclear energy as green.
Very good. Well, that clears it up. That's a big, that was really, really eye-opening idea there, where when you can say to them, don't tell me it's technical because we've got that solved, right? That to me is the essence of it. So that gives me hope, right? That gives me hope that eventually the political veil is going to have to somehow get taken down from the nuclear option, given everything that we're doing against fossil fuels. So, Mike, let's talk about what's going on in the markets right now, because it has become very political, it seems to me. 1 week into the Biden reappointment of Powell, he comes out and he's talking about, that transitory is dead, and we're talking about slowing altering the taper and potentially tightening. Markets have taken that as a signal as the punch bowl is being taken away. Commodity markets have backed off. Crude oil has come back off hard, about 15-20% off the highs. This, to me, is the back and forth of the trade, right? It is the commodity markets bubbling underneath with natural demand and decreasing inventories, tightening spreads, backwardation, et cetera, versus the political side that says, hey, this stuff that we're doing might be causing this, it might not, but we got to figure out how to stop the commodity markets from going up in our face. How do you think, can you speak to that a little bit? Like, that to me is the back and forth of the commodity trade, right? We're all cheering at the highs. The politicians are ready to knock the price down. They've done that. What's our next move? For me as a trader, I'm looking to buy it because I think the commodity story reasserts itself. What do you think as a scientist and somebody that's just sort of navigating the space in a different angle?
Yeah, I think you have to look at the fundamental drivers. So first of all, if we take a step back, oil is off from the highs. We're $115 off the lows from March of last year. As artificial as those lows might have been, the move in oil and gas has been substantial. Nothing goes up in a straight line. I keep coming back to, where's it going to come from? So if you look at the capital expenditures of the majors, they might be up slightly over last year, but they're nowhere near where they were in the go-go days. Josh from Bison Research, his last name is escaping me. He's put out some pretty fascinating pieces questioning whether OPEC's excess supply does even exists. I just looked him up. His name is Josh Young. I want to make sure I got his plug out for him because he does some really great work at Bison Research. And he was early on this, saying this excess supply that OPEC claims to have might not be so real. If you just drill down into Russia, they're not doing near enough exploration to replace the reserves. Neither are the majors. And so if you're cutting capital, here's the thing about commodities, which makes them fun and makes them frustrating. It makes them exciting. It makes them volatile. The supply and demand doesn't just get turned on with a switch. These are actually asset intense, low return on capital projects that require huge engineering and technology prowess to even pull off. If you mix in the slightest of economic uncertainty, capital freezes up. So I would point you to an interesting situation that's developing that maybe some of the viewers aren't following so closely, but what's going on in Peru? With the copper mines, left-wing government coming in, sort of seems to be embarking on all of the classic steps of nationalization. Then you have to study whether such a government could survive, and will the leadership be impeached? But commodity investors and companies that specialize in the space, they abhor uncertainty. So if you don't know what the 20-year outlook for your billion-dollar investment is going to be, maybe you take your time and do a bit more study before you move from engineering to construction. Because you spend $1 billion, you dig a deep hole, you get the mine operating, and then suddenly the rules change, and the royalty share to the government goes up, or the taxes go up, or your license to operate gets pulled, or protesters show up at the gates and burn down your workers' housing complex, which is what, if you go into Peru, you are going to see, I believe, if things don't resolve there quickly, substantial pressure on copper supplies, just at the point where we hope to be at the sort of beginning of the exponential curve for electric vehicle adoption. And so those types of constraints is another thing we think about. We've already talked about arbitrage. We love arbitrage. We're going to be putting out a piece after this interview. The working title, we love titles here, but the working title is Herbie Spoiled the Party. And there's a really great book written in the early 1980s called The Goal. And it's a novel, but it's really sort of the Bible for running a business in heavy industry. You have to manage to your constraints. And, if you're talking about huge billion-dollar projects and suddenly you can't get copper, that throws a wrench in the whole supply chain. And so we look for arbitrage situations, and we look for situations where growth and or supply shocks create new constraints that the market doesn't quite see. And then we try to highlight those and feed them to traders like you so that you can have that as an input into your sizing and your speculative process.
Yeah, no, that's perfect. And I love that. I love that you highlighted the copper markets and the sort of tenuous nature of the copper production from South America. Copper to me has been one of the most difficult parts of the commodity trade post-lockdown, because copper got right out ahead of everything, got through 10K. It was a lot of sort of went along with the pushing the electronic vehicle narrative. The whole world knows we're going into this, big EV, power curve, as you say, with limited copper supplies. And I think, to me, that's why copper has been sort of hanging in here, not far from 10K, near the all-time highs, as other commodities pulled back. Because, as you say, if the supply is going to be limited looking forward, and we're really going to push into the ESG movement, well, then we're walking into the copper hardware store, and there's not a lot on the shelves, right? So do you think that the cost of input slows down the ESG movement? Or do you think that it's like, no, it's government money, it's taxpayer money, they're going to keep plowing away as hard as they can to get this on the tape? What do you think about that?
Yeah, so maybe let me reverse and give you a quick signal to look for. So one of the things we try to provide our readers is, what are the milestones that we talked about earlier? What could you look for? One of the companies we follow a lot is a Canadian mining operation called Teck Resources.
Yeah.
And the symbol on the New York Stock Exchange is TECK. We have no position, just full disclosure. But they have a huge new copper mine they're trying to bring online in Chile. It's called QB2, stands for Quebrada Blanca Phase 2. It's in the process of coming online. They're sort of past the apex of maximum spend. If they start to see local challenges to QB2 coming online, and they start to slow down the turnkey of production, that's going to be a huge signal that that things could get tight in the future, and something, as a trader, which we're not, I would be keeping a close eye on. So one of the things we like to do for our readers is to point to unique and interesting situations that might not be on the radar for signals and inputs into how they think about a market. To your broader question about the boomerang potential of ESG, I think a lot of it depends on how cold it gets in Europe this year, and whether the supply chain whips that we worry about potentially materializing because of the high price of natural gas, whether those begin to show up on the shelves in the U.S. As well as we approach holiday shopping season. It's, again, one of the things I try to explain to my friends in the ESG space is we agree on the desired destination. We're just arguing about the path function. What's the trail look like? Are we going to take the smooth trail with very little, height gains and small hills, or are we going to take the trail where we have to do a walk across a rope bridge over a fast-moving river and hope we don't slip? Right now, the ESG movement is hanging on to that rope, hoping it doesn't slip, hoping that it gets warm in Europe, hoping that they don't see rolling blackouts, hoping that this fertilizer crisis somehow, through some miracle, does not manifest itself in higher food prices in the emerging economies. And in fact, I think if you had a cold enough winter, we said this in one of our pieces, the future of the EU could be in jeopardy. There's some real serious sort of, if you do a Monte Carlo simulation of potential outcomes with probability inputs, there's a few scary outcomes on the board that nobody's thinking about, including the dissolution of the EU, as every country says, forget this, we're going at this for ourselves, which is what China did when it limited phosphate exports and really put a wrench in the fertilizer market. And so we're seeing this nationalistic movement in the commodities space. That's always been that way. As long as there have been copper mines, there's been people protesting the copper mines. Let's not kid ourselves. There's nothing new about this. If the combination of factors that we see evolving in Europe manifests in a true calamity over there, there could be some pretty, fat tail risk, 5, 6, 7 sigma event type outcomes that would surprise people coming off that board. But in the U.S., we're still largely okay because we have such a rich abundance of natural gas. But we do import a lot of critical goods, and they're sitting offshore in these boats today. So we'll see. It's a complex situation.
Yeah, it is a very complex situation, but it's amazing to me how, as a commodity trader, you see them forcing the ESG trade on the tape. And, you see the commodity markets go and take off in response. And then you see the political wheel go in motion and say, hey, we've got to stop these commodity prices from, and it's just like, it's like they're trying to be the cause and the effect of the problem. So for the trader, for me, that's the hardest signal to sort of, the noise to kind of weed out and figure out what the commodity markets are really saying.
So here's a fundamental axiom that you can use as a trader. All American politicians in particular, but most politicians in the world and all American politicians manage to the optics, not to the outcomes.
Right.
And so you can go broke betting on the competence of American politics these days. Our political system is really broken, ineffective, can be counted on to do the stupidest thing possible at every turn. And I say that in with all due respect. But for example, with Europe starving of energy, literally, we have senators from the sort of progressive ESG crowd talking about shutting down LNG exports from the U.S. because the price of natural gas in the U.S. is up 100% over last year. Yeah, it's up 100% over last year. It went from $2.25 to $5. Okay, how would you like to be paying $30 a million BTU natural gas? Now that is a very important signal. Imagine if that did happen here, what our government response would be. It would be pretty collectivist. It would be straight, price controls, all of the worst decisions that everybody makes. Already we're seeing jawboning from the same administration that began office by limiting fossil fuel production. You're seeing them talking about, greedy corporations and profits and, as though they had nothing to do with the situation we find ourselves in. So You, as a trader, need to always assume that politicians will manage to the optics.
I love it. And I love it because, they took that, they sort of never let the crisis of the Omicron variant go to waste. If you look at it, what just happened, right? It was like, Omicron variant came around. Let's jump on that deflationary bandwagon, right? And let's push that as far as we can because it's working for us here in the commodity space. Right. And then you send Jerome Powell out to say that we're going to tackle inflation. And it looks like, they're back in, they're back on the control again. Right. Oil's falling. They're saying, hey, you know what? We might do more of an SPR release. Right. So it's really this whole trade for me. And that's why I love your approach, Doom, so much is the trade to me is managing the back and forth between how the politicians manage the optics, because we know damn well that if natural gas gets out of the headlines or gasoline gets out of the headlines for 2 or 3 weeks, we're going to be back to selling electronic vehicles again, right?
Yeah, and these things, in the end, it's fascinating, it's frustrating, it's interesting, it makes you laugh, it makes you shake your head, and ultimately, all politics is kind of local, and that's why you have, U.S. senators talking about halting U.S. LNG exports. If you just think about what do you think the price of Dutch TTF goes to if the U.S. can't supply LNG to the world these days?
$100.
Oh, easy, overnight. And then you're going to talk about a true catastrophe. So there's 2 ways to get to the right answer: the easy way and the hard way. And we can point out what the easy way is or what it could look like. Obviously, we're not so arrogant to assume we know everything. But there's some broad strokes where you can say a policy of natural gas replacing coal supporting nuclear energy while you're building out wind and solar with the appropriate amount of grid storage so that you don't destabilize things is probably a smarter way to go about it than what we're doing. And so, better is better. We close the piece with better isn't better when zero is the only answer. You can go to zero fossil fuels overnight. There's just going to be a lot of dead people. And we start with a human first mindset where our philosophy is how do we provide the most equitable. By the way, the conservatives listening, we think that there's many issues with the way in which we distribute that energy today. It's totally unfair. Income inequality is destabilizing. There shouldn't be a billion people in the world that don't have food, water, or housing. We could solve that problem today. There are no technical challenges. It's just political, just like with nuclear. We choose not to. We wrote a piece about what if electricity were free, and one of our sad conclusions were a lot of poor people wouldn't benefit from it because water's free today, and a lot of poor people don't have water. So it's not like we're just right-wing conservative drill baby drill type people. We're all for removing coal with natural gas. We're all for nuclear. We're all for renewable. We're for grid storage. Even in the car space that you just talked about, we think plug-in hybrids are a better transition technology because it uses less batteries, which means you rely less on nickel, copper, lithium, and all the green metals as they're trying to relabel themselves for full battery electric vehicles. So, there's thoughtful, smart bridging approaches, but it seems like we're hell-bent on doing it the hard way.
Yeah, exactly. But the real, I guess, to come full circle with this is that we're going to have to keep, watching the ebb and flow of, the commodity markets bubbling up underneath with tight supplies and real demand. The political side continuing to be pushed to the ESG trade more and more, and it's going to be managing that. But my most important thought about this whole thing that you gave me a lot of confidence in with this conversation is that the commodity market right now is still a bubbling, sort of smoking volcano and has not started erupting yet. And I'm very much of the mindset that we will probably see a cold snap in Europe that is going to make the volcano explode. And we are probably going to see sort of, $6 or $7 gas here in the United States. And that is going to be another sign of the volcano exploding. Like, people don't realize what happens when natural gas goes. They see what just happened when natural gas went from 2 to 5, but have they seen 2 to 10? Right. And so I'm trying to get my clients, my listeners and readers prepared for, be very careful because the volcano is still only smoking. I don't think that it has erupted yet. What would you think about that?
Here's the analogy I would make and maybe help you build a framework around it. You need to view sort of the lockdown politics in the same way that we view central bank policy for normal equities. And so absent this new variant, I don't think we would have seen the oil pullback that we've seen, because that's truly the only deflationary countermeasure that is effective for derailing what otherwise was a pretty strong commodity train. And so you got to look at Fauci the way you look at Powell. And same thing in Europe. Like, you can look at natural gas producers, but in reality, Putin's going to determine what the price of natural gas in Europe is for now. And so Putin is the Fed chair for natural gas prices in Europe and Asia.
He's a hegemon, right?
Exactly. And so, the commodities trade, it might be temporarily derailed by the deflationary shock of another partial lockdown, assuming they're successful. There's a risk of that, which we observe, which is that societies are kind of getting fed up with the whole lockdown concept. And so if you start to see governments getting toppled as populations protest the lockdowns, and maybe you start to see like what we saw in Chicago, where the police union seems to have prevailed over the mayor in their little vaccine standoff, mandate standoff. We've written about that. That's another political win you have to pay close attention to, regardless of your beliefs about it, regardless of your personal choices. You have to be acutely aware of the lockdown intentions, effectiveness, supply chain issues that causes. But I think that only postpones it, Tony, because what we'll see is when we reopen again, it's going to be even worse.
Exactly. So we still have, it's like we're still being held back from going into a wide open economy, free air travel, full economy, et cetera, et cetera. And if you want to believe, like, I guess I want to believe that we're going to go back to that, I still see a massive inflationary leg to this trade. And so that's why I'm not willing to say, oh, okay, there's another variant. I'll just give up on the inflation trade because this is going to stop it dead in its tracks. As we all know, commodity markets don't work like that.
It might just affect your timing, your position size, your hedging, all the things that we have no expertise in. But for us, the model on commodities is lockdowns are the central banks. And because it's a straight toggle, Tony. If you lock down, you get a deflationary pocket. Yeah. Then governments overreact and they give money to the people. And then by the time they open up, they have all this extra cash on the sidelines. And boom.
And here we go again.
You get another go of it. And like all of these crises, I saw somebody on Twitter make the analogy of after 9/11, each terrorist attack gave us a smaller dip and a quicker recovery. And eventually, when a bomb goes off in a country, post 9/11, it didn't really affect the markets. As this virus plays out and we get, hopefully, more and more contagious variants that are less and less severe, and this sort of becomes an endemic as opposed to a pandemic, we're going to see less and less market reaction to whatever Fauci is saying on ABC News tonight, and more looking through that news and getting ahead to what markets are supposed to do, which is price the future. But right now, it's still, as proven by the latest reaction to this Omicron variant or whatever they call it. It's still a big input. You can't ignore it, and we sort of until that changes. Fauci's driving the bus on commodities.
That sounds like the case. I think that we can accept that. I'm going to continue to watch the spreads and watch the commodity tightness underneath the markets and see if that shows its face again. If there's anything that this whole conversation around inflation, around supply chain kinks, around energy is life and making your environment work for you, you have turned me into a more serious from a very casual prepper. And I want to sort of change and pivot into that now. While we're still fresh. And, there was a time when I had mostly sports equipment, guitar cases, and maybe a couple of bottles of liquor down in the basement. And now there is a very serious set of shelves, with several weeks or months supply of the things that we go through in our home. And that is largely due to your advice of sort of, expanding the working capital of your inventory, of your house, and expanding your inventory. So what has, tell me, number one, there's two ways I want to go with this. Number one, just give your spin on why you do it and how you do it. And number two, I want to sort of, anybody that does it hasn't prepared for a situation where they're going to go a long time without supplies. I think the world right now should convince you that you should probably start thinking a little bit more about that. So how do we get never preppers to sort of say, you know what, maybe a couple $100 worth of stuff in the basement isn't a bad idea. So let's go ahead and riff on that.
Yeah, I have a distinct memory of talking to you in the early stages of the lockdowns from last year. And you were heading into Costco, and I was screaming at my phone at you to hammer bid. I said, buy. I said, buy indiscriminately.
Yeah, you were like, get 6 carts and go back to the car 5 times.
Yeah, and we had a good laugh about it. But in reality, we wrote a piece called "One Flew Over the Prepper's Nest," and where we confess that the Doomberg team are semi-serious preppers. So I don't want listeners to think that we are. We've built some underground bunker and we've got, 10 million rounds of ammunition and 50 years worth of food. We come at this from a very practical perspective. And in that piece, we described how we view our homes as factories. And the main product of our factories are the health and well-being of our families. And there's 4 inputs into your home. There's electricity, water, heating, fuel, and products and services. Amazon shows up a lot at my place. And the 2 outputs are sewage and garbage. And you need to be mindful that those 6 variables could get turned off. And so our reaction to just-in-time inventory is as follows. If the retail outlets and online facilities from which we procure are only going to stock 3, 4, 5 days worth of inventory. And the 3, 4, 5 sigma event could knock that off for more than that time. Then we need to move the working capital from their shelves to ours. And we have a lot of philosophies, which is eat what you store what you eat. Comfort matters. Don't go too crazy. We kind of plan for 30 or 45 days of excess supply. The simplest thing you can do is double the size of your working pantry in your kitchen. In a way, it serves as both insurance and a free hedge against inflation, because all the stuff you bought last year is more expensive now. And so one of the analogies we use when we say it to people that makes sense, which is I pay insurance on my home every year. I've paid insurance on my home every year. I've had one. So have you. At the end of the year, when my house hasn't burned down, I don't bemoan the fact that I paid that insurance bill.
Right.
And so why wouldn't I happily pay my insurance? Well, the home is a physical entity. It's an important asset on my balance sheet, but so too is the health and well-being of my family. In fact, the health and well-being of my family is way more important than the home that I'm paying, pick your favorite number, $100, $150 a month to insure. So if you're willing to insure your home, why aren't you willing to insure your family? And so we're not talking about buckets full of rice in Mylar bags, although I do have those. We're talking about doubling or tripling the working capital of your fridge, buying stuff you normally eat, but having twice as much of it around, thinking about all the consumables in your home like a factory manager. So, I take pride in how well organized our home is and how happy the home is and how well run it is. And we encourage our friends and now our readers through this piece to think about doing the same. It's not about preparing for the apocalypse. It's about shaving off edge cases from your risk management profile, just like a trader would do.
Right, exactly, and that's why I like sort of bringing it into the mainstream a little more, because I don't think that there's anything radical about it, and I think that people will thank you, most profusely if you run into that 2 sigma event or 3 or 4 sigma event, and you were able to say, probably want to stock up the basement with some more, cleaning goods, plastics, medicines, more food, et cetera, et cetera. And now when everybody's out there in a panic, you don't have to be.
Exactly. And that's one that's really important. And if it's the only thing that people do that are listening, if you have serious prescription drugs that you need to maintain a healthy life, have some working capital invested there. The pharmacies might close. Right? What are you going to do in that case? So everybody's medical situation is unique, but I ran into this in my personal life through a family member that we had to help because the shutdowns, closed a certain border, and that screwed up some health plans that they had. It's a serious issue. The supply could go away. Have a little bit of extra. It's a little bit pricey up front. The consultants will tell you want to run a lean operation. That's fine for a widget factory. That's not fine for my family, at least mine.
Yep. No, I like it. And it just shows a tremendous amount of care. And, it just shows that you're paying attention to what's going on, both, within your biggest and most important asset, and as it relates to everything that's going on in the commodity markets in the world. I think that we've probably covered the 4 topics that I wanted to cover really, really well here. And I want to just do a rundown, just a recap. So, we've still got Biden energy policy continuing to clamp down on fossil fuel supplies. We've got the second dynamic of the same administration trying to help use the Omicron variant to be the deflationary force, that helps them in the energy price side. We've got a bubbling situation across the pond because they're basically made Vladimir Putin the price maker of natural gas because they haven't supplied it themselves. And now, full circle, the whole world, because of this, has got to take a look at this uranium trade. And so I feel like we're leading people in the right direction. I'm not going to say it with 100% confidence yet, but I think that if you and I have a conversation in 3 to 6 months, that a lot of the things that we spoke about will be even more relevant. So I look forward to a follow-up as much as I do, as much as I did this conversation, because my favorite thing is the revisit, right? Let's look back on what we said. Let's look back on see if we gave good advice. But I'm going to let you close up in a second. But my line of thinking broadly speaking, is still, due to the situation, the volcano of goods shortages, inflations, and supply chain issues is still smoking, and really ahead of us has the potential to erupt. And I want to be really prepared for that. How would you close up today's combo, Doom?
I would close up by saying the very best way to get an edge on that follow-up conversation is to head over to doomberg.substack.com, sign up for free with your email, then head over to tgmacro.com and get the best the best market analysis from a fantastic trader in the business. And if you have Doomberg and you have TG Macro in your reading routine, you're going to be very well informed for whatever happens in the next few months.
Man, I'm really honored by that endorsement. I really am, because I think we're a pretty good team. I can tell you that you have helped my trading operation massively. I can tell you that I try to read the Doomberg Substacks as they come out, as they hit my mailbox, because there's so much relevant information in there that is so liberating for a trader. And that's the important thing here for me. And I really have to really hang on that point, because as a trader, you've got all of these prices flying around in your face. You've got positions getting away from you. You've got positions that are crushing you. And you've got to be able to lean on what you know to be true as the sort of backbone of your thesis. Now, the trading positions are going to, we're going to go in and out of trades, but being armed with this knowledge has been, among the best things that I've done over the course of this year. And I'm grateful to you for supplying it all in such a brilliant form, the way you present your content. And I am looking forward to reading every Doomberg Substack that you put out in the future. Thank you so much for being with me here today in this conversation, Doomberg. This was fantastic.
Thank you. And thanks to the Real Vision team for letting us do it.
The Real Vision team is the bomb. You're the absolute best. Lastly, just give us your last credentials where we can find you on Substack and on Twitter before we depart.
Yeah, doomberg.substack.com. Sign up with your email. It's free. And on Twitter, you can find us at Doomberg T. Just add a T to the end of Doomberg. The T stands for terminal. Doomberg is Chicken Little Gets a Terminal. That's our sort of brand moniker. And love being here. I'm happy to come back anytime, and hand in glove with each other, brother.
That's right, my man. I don't know what else we can do for our clients. That is the place to subscribe. That's where to follow the Doomberg Chicken. And we're going to come back in 3 or 4 months and see how we did on some of these conversations.
You bet.
Thank you very much.
Hi there, visionaries. If you want to get more of these kind of insights, join our community over at realvision.com. There you'll get unbiased insights and exclusive access to the very best, brightest and biggest names in finance. Be a part of our community of lifelong learners. See you there.